But I want to come back to Bay Street and the pain seen for Valeant investors as the shares ended the day down more than 11% after the company announced Michael Pearson's on medical leave. For perspective on how we handle this and the volatility, we're off to Winnipeg to speak with National Bank Financial's Rob Tetrault. Good to have you with us.
Great to be here, Michael.
Are you as concerned as the others we've spoken to that it's very difficult to run a company that's under this much scrutiny by committee?
Absolutely. I've stayed away from Valeant for a while, and for this is more a pain, I think, for shareholders. Running a company by committee can be very difficult. Not only that, what's the succession plan for this company? A lot of volatility lately, a lot of ups, a lot of downs, and this whole Walgreens deal, obviously the market doesn't like the fact that Mr. Pearson's out.
You know, pneumonia can creep up on anybody at any point. Is it really fair to slam the company? I'm not saying you are, but is it fair to be upset that the company didn't have a succession plan in place for a man who, for all intents and purposes, was the picture of health otherwise?
Yeah, I mean, if we look at what Mr. Pearson's done with this company since 2008, he's literally taken it from a small player to, the largest company on the TSX this year. So, he's not getting any credit, no respect for sure. And pneumonia obviously could hit anyone, but I think the issue is what has been happening in the last couple months here and how have they reacted. With nothing prepared for that, it's obviously been difficult for the market to digest this more negative news again.
So if your phone rings and it's a client who says, I own Valeant Pharmaceuticals, I've seen the stock tumble as much as it has since the price gouging allegations on Capitol Hill and then the short selling kicked in, what do you say to someone who owns shares today?
Honestly, I'd say it depends on two things. One, how do you feel about it at night? Is it keeping you up? Is it something that's affecting your health? And if yes, get out. If you have a well-built portfolio, if you have a diversified portfolio, you will be fine. One holding will not ruin your portfolio. Get out, cut ties, move on. It's a stock like any other. There are plenty of good companies out there. If you're not terribly concerned about the day-to-day volatility, I would suggest to you cut ties in the next week or two or three or month when there's a bit of a rally. Next time there's maybe an up week or an up couple days with this stock, you could cut ties then. I'm personally not long Valeant, and none of my clients are.
Oh, is the idea here, Rob, that if you saw tax loss selling in the month of December, in January, anybody who still believes in the company would buy it back?
That's the idea, right? So anyone who sold that company now, obviously we know that today was the first day for the 2016 trading year, and last week was the last day for tax loss selling. So those sellers are now out. So the idea is that in theory, you should see some sort of a bump here in the next few days. So today's reaction is the pneumonia incident, and perhaps later this week and next week, we'll see a little bit of a bounce here. That being said, I would still get out.
What do you make of the move today on Bay Street generally? I see that Staples stocks were in favor in this session. Why?
Bay Street today, low volume. I don't make too much of it. We're talking 70 points. We're talking, 0.5% on very low volume. You mentioned it, 40% less volume than normal. I don't make tons of it. I think south of the border was more important and was more newsworthy for sure today.
In what way?
Well, we had a 200-point update today, so we're talking about those consumer discretionaries, consumer staples, on the heels of big retail numbers. The Schiller Price Home Index numbers came in good. There's been some good macro data here already in what's been a very short week for us, but there's been some good macro data, and hey, 200 points is a great start to the first non-tax loss selling day of the year here.
I can
People
imagine
are getting back in, obviously.
Yeah, but you wouldn't want to be in staples, I can imagine. If you had faith in the health of the U.S. economy, wouldn't you prefer to be in discretionary?
Discretionary, absolutely. If you believe that we're kind of in the upswing of the cycle here, you want to be in those discretionaries. You want to be in any company that's not a staple. You want to be in Amazon. You want to be in Nike. You want to be in those companies. And they've outperformed this year the staples by around 20% or so. So if you believe that this cycle in the States is nowhere near done yet, you want to be in the discretionaries.
Now, I know there are 3 Canadian companies that you do like. You've got Artis Reit, Boyd Group, and New Flyer on your radar screens. Of those 3, which one is your favorite?
Well, Michael, let me just point out, first of all, that I'm a Manitoban. I'm a homer at heart. That's why I cheer for the Jets. That's why I cheer for big Team Canada win today in overtime. But I'm talking about Manitoba companies. Those 3 are Manitoba companies. My favorite for sure at this point would be Boyd. I like what they're doing. They're effectively churning out mom and pop stores. They're buying them at a crazy discount. They're applying their model to it. They're not raising equity to create a huge growth We're talking same store growth and we're talking acquisition growth. They're growing twofold. They're growing almost double digits on both sides. And because of that, the stock has just boomed and is roaring. And I love it for that. It bounced back a bit off its high, so we're down to the 64 range. I like it at this point. I think this is going to be an $80 stock in 2016.
All right, Manitoba Man, why go for a Boyd if you think that people are going to be buying cars? Why not go to an auto depot type scenario instead?
The reason I like it is I like their model. One, they have forgivable loans with a lot of their suppliers. So we're talking paint suppliers and glassware suppliers, forgivable loans. And two, again, is the growth. They got tons of cash. They got $350 million of capital sitting there either in a credit facility or either in cash. They got almost no debt. So if they decide to get a bit of leverage going here, and management might do such a thing, and they start acquiring one-offs, shops, and even franchises, if you will. They just acquired 2 of them earlier this year. We could see some big growth numbers, and I think their plan is to keep growing roughly 7 to 10% on the same store growth, and another 7 to 10% on the new acquisition growth. That makes them for some very nice growth, and it's trading at a multiple that you wouldn't think. It's a bit of a discounted multiple in my mind. And
when it comes to a dividend, it's not even a full percentage point at this point. Do you think 2016 is the year they start giving us back a little more? Well, they just announced a couple small dividend raises. These guys were in the penalty box. I don't know if you recall this, but several years ago they were in the penalty box. The stock got hammered. They barely survived, and now they're holding on to their cash like a mature company would. Now, the point here should be that they should be able to grow. They should be able to grow when they're keeping that cash. I don't want the dividend. Honestly, don't give it to me. Invest it, take care of it, make me more money than I can make with my 1%. So I'm happy that they're keeping the dividend. Keep it. Take care of it. So we're looking at the stock at $64.80. What, Rob, did you say your 12-month target price was? I think this could be an $80 stock in 2016. So about a 22% upside from here? Yeah. Rob, fascinating stuff. Thank you so much for your time. Go Jets, go. Rob Tetrault, a portfolio manager at National Bank Financial, joining us from Manitoba.